Policies, life insurance policies, provisions, options, and riders. Generally, the person who pays for the premium for an insurance contract is designated as the policy owner or policy holder. Although there are no provisions in life insurance policy specifically titled rights of ownership. In fact, owning a life insurance policy does not entitle the important rights. These rights are woven through the policy in various clauses and provisions. The most significant right of ownership includes the following: the rights to designate and change the benefits of policy proceeds, the right to select how the death proceeds will be paid to the beneficiary, the right to cancel the policy and select a non-for future option, the right to assign ownership of the policy to someone else. Standard provisions, policy provisions. The clause and provisions that set forth these rights will be examined in this and later chapters. Despite efforts by the insurance company to offer products different from their competitors, insurance policies are more notable for their many similarities than differences. The foundation of the uniformity is rooted in the state-level regulation and industrial and adoption of NAIC guidelines. Regulatory in each state protects consumers by establishing strict guidelines as to what must and what must not be included in an insurance policy. Furthermore, in an effort to promote state-by-state uniformity of insurance industrial regulation, most states have adapted the standard wording of NAIC model regulation. Accordingly, policy language is similar among the many different life insurance contracts available to consumers. We will begin this section with a discussion and standard provisions that appear in most life insurance contracts, and then take a look at some common exclusions. Entire contract provisions. The entire contract provision is found at the beginning of the policy, states that the policy document the application which is attached to the policy and any attached riders constitute the entire contract. Nothing may be incorporated by reference, meaning that the policy cannot refer to any outside documents as being part of the contract. The entire contract clause has another important function. It prohibits the insurer from making any changes to the policy, either through policy revisions or changes in the company's bylaws after the policy has been issued. Insurance clausing. The insurance clausing or provisions set forth the company's basic promise to pay benefits upon insured death. Generally, this clause is not actually titled as such, but appears on the cover of the policy. An insuring clause might state that the promise to pay is subject to a policy provision, exclusion, and conditions. One company's insuring clause reads, "The insurance company agrees in accordance with the provisions of this policy to pay the beneficiary the death proceeds upon receipt at the principal office due proof of the insured death prior to the maturity date. Further, the company agrees to pay the surrender value to the owner if the insured is alive on the mature date." The insuring clause is typically undersigned by the president and secretary of the insurance company. Owner's rights provisions. The owner's rights provisions defines the person who may name and change beneficiaries, select options available under the policy, and receive any financial benefits from the policy. Free lock provisions. The free lock provision required by most states give policy owners the right to return the policy for full premium refund within a limited period of time after the delivery of the policy. Consideration clause. Consideration is a value given in exchange for contractual promise. In the life insurance policy, the consideration clause states that the policy owner consideration consists of completing the application and paying the initial premium. The consideration clause or provision in a life insurance policy specifies the amount and frequency of premium payments that the policy owner must make to keep the insurance in force. Grace period provision. Grace periods are permitted in a lot of other financial products such as consumer loans, mortgage, credit card payments, etc. The grace period in life insurance is meant to protect the insurer if there is a slight lapse in the payment of a premium. If it is to prevent the life insurance company from forcing the insured to provide insurability. Again, in the policy for which the premiums are paid monthly, the grace period is for 1 month, but no less than 30 days. If an insured dies during the grace period and the premium has not been paid, the policy benefit is payable. However, the premium amount due is deducted from the death benefit paid to the beneficiary. Reinstatement provision. It is also possible that due to non-payment of premium, a policy may lapse either deliberately or unintentionally in case where a policy owner wishes to reinstate a lapsed policy. The reinstatement provisions allow the policy owner to do so with some limitations. With reinstatement, a policy is restored to its original status and values are brought up to date. Most insurance requires the following to reinstate a lapsed policy. All back premiums must be paid. Insurance on past due premiums may be required to be paid. Any outstanding loans on the lapsed policy may be required to be paid. The policy owner typically will be asked to provide insurability. Policy loan provisions. State insurance law requires that cash value life insurance policies include a policy loan provision. This means that with a prescribed limits, policy owners may borrow money from the cash value of their policy. If they wish to do so, a policy loan is more advanced on proceeds than a true loan. As such, these loans may not be called by the company and can be repaid at any time by the policy owners. If not repaid by the time the insured dies, the loan balance and the amount in any interest accrued are deducted from the policy proceeds at the time of the claim. If the policy is surrendered for cash, the cash value available to the policy owner is reduced by the amount of the outstanding loan plus interest. When a life insurance policy owner obtains a policy loan, the collateral for the loan is cash value for the policy. Interest rates on policy loans vary, but most states stipulate a maximum allowable rate. Some new policies are issued with a variable interest rate tied to the Moody's Corporate Bond Index. If the policy owner does not make a schedule interest payment on the policy loan, the amount of interest due will be added to the loan balance. If in the event a policy loan plus interest exceeds life insurance policy cash value, the policy is no longer in force. Incontestable clause. The incontestable clause or provision specified that after a certain period of time has elapsed, usually 2 years from the issue date, the insured no longer has the right to contest validity of the insurance policy so long as the contracts continue in force. This means that after the policy has been in force for the specified term, the company cannot contest a death claim or refuse payment of proceeds even on the basis of material misstatement or concealment. Although the incontestable clause allows death benefits in general, does not apply to accidental death benefits or disability provisions. If they are part of the policy, Because conditions related to accidents vary and are often uncertain, the right to investigation then usually is reserved by the company. The inconstantable clause applies to the policy face amount plus any additional riders that are payable at death. The inconstantable clause allows insurer to contest a claim during the constitutional period. It should be noted that there are three situations to which the inconstitutional clause does not apply. A policy issue under any of these circumstances would not be considered a valid contract, which give the insurer the right to contest and possibly void the policy at any time. Impersonation. When applicants for insurance is made by one person but another person signs the application or takes the medical exam, the insurer can contest the policy and its claims. No insurable interest. If no insurable interest exists between the applicant and the insured at the inception of the policy, the contract is not valid to begin with. As such, insured can contest the policy at any time.